What is the biggest myth or misunderstanding people have when it comes to filing tax?
That when you're filing your taxes, you're going to get something in return. Maybe you will receive a refund.
So recently, India became the third largest economy in the world, surpassing Japan. Okay, so how does this impact an average middle class Indian in terms of, say, salaries, in terms of job opportunities, or it's just a hype that has been created?
So I think it's not just the hype that you're speaking about.
Okay.
So when the country is developing at a macro level, obviously at the micro level also there are a lot of opportunities that come up.
Do you think younger generation should start using credit card or they shouldn't?
See, I think everything that you use, it has a purpose, right?
Yes.
If you use that particular product properly, there's no harm in it, But if there is a misuse,
what's your take on IPO? Is it a smart move for early gains? Hi Aniket, and welcome to Beyond Spotlight with Chaitanya Naik.
Thank you, Chaitanya. Thanks for having me here.
How are you doing?
All good.
So Aniket, I'm super excited to have this conversation with you today because you've taken a time out of your busy schedule. I know it's like super crunch time for you because of the tax filing and all, but yeah, great to have you over. We are going to talk a lot about investments, tax filing, then all the other related questions to their journey of becoming the CA. Okay, let's start.
Sure.
So tell me, Aniket, so being a CA isn't every kid's dream, okay? What made you pursue this field? Was it family pressure? Was it love for numbers? Or was it something completely different?
So Chaitanya, that's a very interesting question. So as you rightly mentioned, there won't be any kid out there who in this early schooling days would think about becoming a CA. If I speak about my journey, there's no one in my family who was a CA before. I'm the first person who became a CA. Academically, I was always good with numbers, and that's how it laid the foundation of becoming a CA or choosing CA as a profession. As I cleared my schooling, I took commerce as a field, and even after taking commerce, I was always very attracted to numbers, good in accountancy and so on. So that is what actually laid a foundation. And slowly, steadily, when I took CA, I entered CA profession. I cleared my CA CPT exam. I started preparing for the intern, and that is where actually I gained more interest on how the CA profession is working and how it's growing. When we speak about the country, India is a growing economy. It's said that this century is going to shape the India's growth story, and CAs are going to play a very important role in that growth story.
Like how?
So see, because when you see when the economy develops, it's more to do about commerce. How the businessmen are functioning in the country, how good opportunities the employees over here are getting to grow in their professions, right? When we look about businessmen, they want to expand. There are two ways of expanding. One, maybe you expand organically when you develop everything in-house. The second way can be when you expand inorganically. Maybe you are pursuing any merger or any acquisitions, and that is how you grow inorganically. And CAs have a very important role to play in that particular journey because, you need the right set of advisors to advise you on how the funding should be for the transaction, maybe making it more tax efficient, maybe conducting due diligences on whether the acquisition that you're pursuing, whether that's correct or not correct. So CAs have, from a traditional conceptual perspective, they have really expanded their horizon so much that they have become a very trusted advisors for the businessmen. And that is how CAs are actually playing a very important role in growing the economy of the country.
So you're talking about economy over here. So recently, India became the third largest economy in the world, surpassing Japan. Okay. So how does this impact an average middle class Indian in terms of, say, salaries, in terms of job opportunities, or it's just a hype that has been created?
So I think it's not just the hype that you're speaking about.
Okay.
So when the country is developing at a macro level, obviously at the micro level also there are a lot of opportunities that come up. For example, if I take a very simple example, there is a new stadium that has come up in India. Okay. So obviously by ticket sales of the stadium, the revenue is going to increase for that stadium per se. But even if you look at the broader perspective, there will be hotel industry that will come up that stadium. There will be transportation that will be on a rise. So all those things also increase employment opportunities for the country, and that is how it shapes the growth for the nation as well. So even uh, smaller things at a macro level contribute a lot for the growth of people at a micro level.
But if I specifically talk about job opportunities over here, the current trends which are happening in India, the scale is like very like on the a lower side, to be honest, because people are really struggling for jobs and all. But personally, I don't think it's helping a lot. But what's your take on this?
So see, I think there's a phrase that goes with saying being at the right place at the right time. So obviously, when you look at the population of the country, we have a very big population. So the market needs to cater to that big population. So obviously, there can be some areas where the opportunities may be limited, and there will be some areas where the opportunities are in abundance, but people are just not aware. So those are two things, and I think it's about developing a skill, being a bit patient, and that is how you will just land up a correct opportunity. And once you have that opportunity, I think it's all about mastering your skill set and growing in that particular area where you get an opportunity to grow. But I think the opportunity is there in the market.
And where you see like the growth going in the next 10 years?
I think in the next 10 years will be a very crucial phase for the country, and in the next coming years, because when you see new age business models, so for example, you are seeing very recent trend of companies going for IPOs. There are a new set of companies. You are seeing loss-making companies that are going for IPO. Traditionally, the trend was that for going for an IPO, you need to be profitable company, and you should do good with numbers. But as the trend is changing, there are different horizons which shape a company's growth. If you have a good customer base, you have a product. For example, if you look at an e-commerce website, if they have a good number of people that they attract on a daily basis, that's a perspective that the investors are also looking at, and not just whether the company is doing profitably well or not. So I think in the next 10 years, these new age business models are actually going to shape the economy, and that's how the numbers are going to change.
We'll get on to IPO and all, but I want to understand what thing has surprised you in the financial world, which you weren't taught in your academics, or like you didn't get it through while you're pursuing CA.
So, I think when you speak about a traditional CA course, it's more about bookkeeping and accountancy,
Okay.
As and when I got involved with this profession, maybe when I was doing my internship, or as and when I started clearing the different levels of CA examination, I got to know the CAs have actually expanded their role very much. It's not just about the traditional bookkeeping or accountancy. They have gone into diverse professions. So you see CAs playing a very important role in business leadership. Yes. So if you look at the top Fortune companies, you will find CAs occupying the executive roles as well. I know some companies which are in the tech sector, and they have CAs in their operational leadership role. So it's that's how a leap of faith has taken place, and CAs are fulfilling that journey. And also speaking about diverse opportunities, one is, I think, investment banking. That's somewhere CAs are actually at the forefront these days. And there are a lot of other areas as well where CAs are actually ventured into, be it forensics or maybe consulting. These are the areas where CAs are actually growing to be a business partners with the clients.
So AI is also taking over the world. Okay. So how it has affected or helped the CA?
So I think obviously when there is a growth, the growth has to be guided by someone, and you need people to work towards achieving that growth. As I mentioned earlier, when the businesses are growing, they need a trusted advisor to guide them from various intricacies, because when a businessman is growing, it's all about numbers. They need someone who can manage those numbers and increase their profitability or particular goal which they are trying to achieve. That is where CAs come into picture, and that is where they are aiding the businessmen to achieve a scale that they are wanting to achieve.
Has it made your life easier?
I think that's not about making the life easier, but it's about, CAs are always up for challenges.
Okay.
That's what keeps us on our toes. And as and when the challenges increase, I don't think CAs would be the ones to back off. They like to take challenges head on. So that's something which every CA is looking out for. The more challenges that they get in life, the more they are attracted to solve the problem and, come out with some holistic solutions. So I don't think challenges is something that deters a CA.
Now, also talking about the time I'm talking about over here. Like earlier used to take, say, one task used to take, say, 4 hours, 3 hours. Has AI made it slightly easier in terms of reducing the amount of time?
See, definitely, when we speak about technology, that's the, next big thing, and it's here to stay. There's nothing that's going to stop AI.
Correct.
But, there are a lot of areas which AI cannot cover.
Okay.
One thing, if I speak about, is the personal touch. When today, if I'm going to meet a client, a client will always want someone who they can trust upon, someone who can talk with them, someone who can make them understand, and someone who can give them that personal touch. AI cannot do that. Second thing, I think AI is more about learning from what they gather. What's there in the media, they'll just search around and they'll summarize their thoughts. And, something which is very dangerous about AI is AI hallucination. Recently there was a judgment of a tribunal wherein the AI had cooked up some fake precedents to suit the narrative. And that was a very big, what do you say? The market was really surprised. Like, how can a judgment turn up like this? How could these precedents come up? And those precedents were such like no one had heard about, They were really surprised. Oh, there are such kind of a precedents. But once someone sat down and really researched on that aspect, those precedents turned out to be fake. So that is a really big risk that we look upon. So I think when we speak about AI is definitely going to play a very big role going forward. But I think that will not be able to overcome the role that a professional could play. They can definitely help in professional to give better solutions to reduce time and improve efficiencies. But I think that will not be able to replace the skill set that a professional has.
So let's move on to investments now. So Aniket, there are too many options available out there. You have crypto, from gold to SIPs to stocks. So someone who's looking to start investing in 2025, so what would be there or what should be there? No nonsense way to start investing.
So I think, Chaitanya, when someone is starting with investments, something which they should be mindful about is what is their goals. Someone who does not want to take a lot of risk. I think the simpler option would be the conventional FDs, fixed deposits where your money is safe, or something like investing into government bonds or government schemes. These are the options where your money is going to be safe, as compared to an investor who can take a bit of a risk. Obviously the returns would be higher in those cases. You can look at mutual funds, which offer various types of plans, and you can choose a particular plan based on your investment strategy. There are also stocks which you can look upon, and that is how a new investor should look at investments.
But if you talk about MDs over here, isn't that a very safe way of investing? Because you won't earn that much over a period of time. It will be very stable, I would say.
See, that's a correct take, but I think, like I mentioned, it's also very important for a person to know what their strategy is. Suppose I take an example of a senior citizen. His objective would definitely not be to create a very big wealth pool, right?
Okay.
Because he may want to keep his money safe. He may want to withdraw money consistently over a period of time to look after his own expenses. And that is what something a person should be mindful about. FD is going to keep your money safe. It's going to grow at a nominal rate, say 6-7% or whatever it is. But your money is going to be safe as compared to the other options. Obviously, if a person wants to create a pool and he has time with him, he has the risk appetite because other expenses or other goals of him has been taken care of, then he can look at aggressive strategies. And also, I think as compared to the traditional FDs, if you can mix it with the mutual funds, I think mutual funds are also these days offering debt mutual funds where they invest into a mix of FDs, government securities, and certain high risk corporate bonds. So where you can get certain fixed returns and also be at a zone where you'll be earning a little more than what the returns FDs are giving to you.
See, we all love chasing like high returns. Okay. So what is the cost we usually don't see?
See, that's an interesting one. So, as it said, high risk, high returns.
Yes.
So when you're looking at high returns, maybe these days people are too much inclined towards the stock market because of new age technology. You have apps which help you invest into stocks very easily as compared to the earlier days where you used to actually need to go to the stock exchange with the physical share certificate to be able to trade on the stock exchange. So because the times have changed, stock market access is very easy and people have that conception that stock market is going to give you a very good return. And I think that is somewhere guided because of the past returns or the past growth that the stock market has seen. So obviously, stock market has the potential to give you good returns, but someone should have proper knowledge of how the stock market functions. There can be a scenario where you might have invested money. People always look at returns. If I have invested, say, 1 lakh rupees, they want to earn 10% per annum or 20% per annum. That would be their goal. But while investing into stock market, you should also be aware that you can end up losing your money. The amount that you have invested, there can be a scenario where the stock market may crash because of some external factors or the market doing well or the economy not doing so well. As these days, you can see there is a lot of international pressure, which is keeping the stock market corrected. So you can also end up losing your money. So I think someone who is investing into such kind of instruments, he needs to get proper understanding of how that market is going to function and what your returns could be and how it can actually even land you into a scenario wherein you may lose up money. So that is all about being prepared and being a smart person to develop a proper strategy.
Has stock market become too glamorous? Because at the end of the day, basically you're taking ownership in the business, right? So I don't understand this. People see stock market as something they should like invest, and people do invest blindly. I've seen that.
So that's correct. So when you are investing into shares of a company, you do take up ownership of the company. But when you look at a listed company, when we especially speak about retail investors, they don't own that significant stake in the company, right? Because so see, when you look at a traditional or a standard listed company, the promoter, or like for example, Reliance, when we speak about Dhirubhai Ambani or Mukesh Ambani now, these are the person who are the promoters of the company, So they may be owning a majority stake in the company. So they have the actual control over the company. When we look about retail investors, say someone who is investing 50,000 or 1 lakh rupees into shares of a company, he will get a stake in the company, but his stake will be very minimal. So he may not be in a capacity to run the business of the company. So he'll be a minority investor in that company. So in that sense, the main business decision which could be undertaken will be the person who are in control of the company and those who occupy the board seats in the company. As compared to a retail investor, he will just be an investor and he may not have the power to take decisions. But obviously, if the company is doing good, he may get returns, and the returns can be in two forms. One, obviously, is dividends, and second, I think, will be appreciation of that stock value. So these are two returns which a person gets while investing in the stock market.
So see, if I talk about our generation, is our generation too obsessed with quick money and a bit impatient when it comes to investing?
Yeah, that's right, and I think it's not really about the generation, but I think when we look at the younger lot, especially when people really start working, the age group of 20 to 25. So they have a habit of spending a lot, right? So there you will find people who don't have patience, They may want to invest money and they may want returns at a very quick pace. And to, somewhere, I think because of this new age technology and new age business setup, there are mobile applications which can give you instant loans. If you're short on money, you can take loans for as small as 5-10 days, and that loans can run up from anywhere to 50,000 to 5 lakh, depending on your salary. So I think, that is also somewhere changed the conception of the younger generation about money, and how they can, suppose they have invested money into a particular stock or some other instrument, and they are short on cash. What would they do? They may end up taking a loan from this some of these apps, or they may end up using a credit card. So I think that is all about the perception and the spending habits that has changed over the years. And yeah, the younger generation needs to plan better and be wise enough to use their money efficiently.
Do you think younger generation should start using credit card, or they shouldn't?
See, I think everything that you use, it has a purpose, right?
Yes.
If you use that particular product properly, there's no harm in it, But if there is a misuse, or if you are addicted to using credit cards, then that can be a really problematic thing. For example, if you are overspending on your credit cards, so today when you're swiping your card, you may not even realize the money that you are spending, because traditionally you're always trained to spend cash. When cash goes out from your pocket, you can feel the pinch. Today I spent so much money. But when you are swiping a credit card, you actually don't realize the impact that it has caused on your pocket. And that is only when you receive the credit card, you understand how much money you have spent. So I think someone who is using credit cards, that's not a bad habit. It has a good purpose. That's the reason why credit cards have been made. But you should be wise enough to understand and control your spending habits, so that you don't end up spending more than what your capacity is, because that is going to impact you a lot in the long run.
Is credit card a trap?
See, I won't say that credit card is a trap. I think the way credit cards have been designed is they give you the flexibility. If you're short on cash today, or for some reason you don't want to pay today, or maybe you don't want to show so many debits in your bank account statement, you can use your credit card, and at the end of the month, you pay the credit card bill, and there will be only one single entry in your bank account. So there are a lot of objectives which credit card has, and it also helps you achieve those objectives. So for example, if you speak about corporates, there are many corporates that end up giving credit cards to their employees. And the reason being, they want all official expenses to be done through credit cards. The objective that is getting solved over here is the employer can keep a real track of where the expenses are being incurred. There can be a scenario where cash expenses may not be identified, whether those were actually incurred or not. So, credit card helps achieve all those objectives. So I think there is always an objective that is sought to be achieved. But if the credit card is being misused, like any other product, there can be disadvantages, or there can be consequences. One of the things can be like credit cards have a set interest rate. So for example, if you don't pay the credit card bills on time, you may end up incurring interest on those outstanding balances, and those interests are really good numbers, that ends up with the banking organizations earning a very good profit on that outstanding amount. So that's a consequence which a person may face.
So Aniket, what's your take on IPO? Is it a smart move for early gains, or it's a trap?
So I think when you look at IPOs, IPO is basically when a new company, not a new company per se, a company which has been in existence for a while is new to the stock market. Basically, it's going to list its shares on the stock market. When it lists its shares on the stock market, there could be two sets of IPOs that can come up. One is where the existing shareholders of the company may want to offload their shares. And the second would be where the company would be raising funds to fund its expansions, or it can be a combination of both. These days, what we are seeing is company on its own comes up at a valuation which it feels is justified, and obviously that has to have some backing, because even the regulator would want to understand what the pricing of the stock is when it hits the market. And based on that pricing, I think there's a lot of interest that the company gathers for whatever reason it may be. One can obviously be because of the brand value that the company carries. if you look at Zomato or Swiggy, these are companies which we see on a day-to-day basis, These are companies that have reached to the general people of the country. So obviously they had a lot of hype when they hit the market.
Yeah.
So that is also where the investor sentiment comes in. When a company can actually connect with its investors, there is always going to be a lot of demand for that particular share. And that is where the price of the stock actually shoots up. If you look at such kind of company which is coming up with its IPO, and there is an oversubscription to its share price or the stocks which are available, obviously it's bound to give you a good return on the listing date.
Yes.
And that is where actually people are very much attracted towards IPO these days. There is something which is known as the GMP, the grey market premium. And that is determined based on the demand which the stock has even before it has listed on the stock exchange. So a company which has a lot of demand, even before it has got listed on the stock exchange, that is bound to give you a good return on the listing date. And that is where people are actually having a perception that you should go for IPOs, you should apply for IPOs so that it can give you a good return. I think that is not entirely true. If your objective is to earn good money, if you want to stay invested for the long run, that should be the right objective. Because, a company can give you listing gains on the first day, but it may also get corrected in the days to come. There are a number of examples wherein the companies have listed on the first day with a premium of say 50%. But over a long run, maybe even a duration of say 1 month or 2 months, that 50% premium has corrected to come to let's say 3%, 4%, or even in the negative.
Okay.
So that is something a person should be really aware about. It's not that always when you apply for an IPO, you are going to get a return, or if you get a good return on the first day, that's going to sustain over the long run. Obviously, you need to research a bit about how good the company is doing, what its objectives are with the IPO, and then you should decide whether you should apply for that IPO or not.
How do you do that? How do you research about a company?
See, in India, when a company is coming with an IPO, they need to make all the disclosures to the regulator, which is known as SEBI.
Okay.
It is required to file a prospectus, which is known as a red herring prospectus, which lays out the objectives of the issue. What the company is going to do with the money. Like I mentioned earlier, there can be scenarios where the company may not be receiving a single penny from the IPO. It's only the investors of the company who are taking an exit. In such cases, the company is not receiving any money.
How is that possible?
That's possible because see, when you list a company, the regulator wants that at least 25% of the shares of that company should be owned by public and not by the promoters. So basically the persons who have founded the company or who have a majority stake in the company, those people are known as promoters, who are basically in control of the company. SEBI requires that at least 25% should be offloaded by these promoters. So either that can happen by way of fresh infusion, that is raising money from the people, from retail investors, or it can happen by the promoters offloading their stake in the company. So when the promoters are offloading their stake to meet this particular requirement of 25% to be held by the public shareholders, that's where the company may not be receiving a single penny.
It's difficult to understand because, see, so company is not receiving anything. Then why would they have something listed on the own?
See, again, it depends on the objective, There can be a company, for example, me and you have partnered and grown a company, okay? We have invested our time, efforts in growing the company, and today the company is doing good.
Yeah.
Okay? Now, say we have run this company for 20 years or so. Now, we don't want to be a part of this company, or maybe we have some different plans. We want to monetize the company. We have a certain valuation in mind, and at that valuation, we want to offload our stake in the company. We may want to have some role in the company going forward, but not as much as we had in the past, That is where the promoters may want to monetize their investment so that they get the valuation of the shares which they want. And at the same time, they can bring in new professionals in the company who will go and run the business of the company going forward. So that is what is happening. For example, if you look at Paytm, there's a particular gentleman who is well known or well associated with Paytm, who was the founder. But when Paytm got listed, the prospectus says that there was no identifiable promoter of the company
Okay.
because the conditions were not getting met. So promoters also need to have a particular percentage which they need to own in the company. That condition was not getting met. So as and when we see the startups growing, because startups raise a lot of money in their initial phases. So that is why when they are at the stage of listing the company, the initial founders, they may not owning that particular limited threshold which is required to own in the company for them to be qualified as a promoter of the company. So that is very well possible that going forward, there will be more companies which may not be having an identifiable promoter, and also companies which may not raise any money for their company itself. They may raise money or they may bring up an IPO only to provide exit to the shareholders of the company. In such cases, the company may not receive a single penny. And that is also because the company may not even want any money, because the company may be doing good, its growth objectives have been met, or their whatever is their growth plan, they would be having sufficient money from their internal accruals to fund that expansion. And
But don't you think because of this, it's the general people who suffer?
I won't say that. So basically, like I mentioned, if a company is doing good, it doesn't require money to fund its expansion, then why should anybody have a problem? You are getting a company which has already been developed and it has a good track record in the past of making profits. And even when you look at the future, its growth plans have been well defined and they have a clear vision. The people who are in control of the company, combined with the board of directors, they have a clear vision how the company is going to grow in the future. And I think that is not something which is deterring the market, especially the Indian investors, in applying for the stocks of such kind of companies.
I have a couple of more questions in this segment of investment. Okay. So what is one thing which separates a person who stays broke and a person who generates wealth over a period of time?
See, I think two things are very crucial over here.
Okay.
One would be patience and the second would be planning. So basically 2 P's. You need to be patient so that, you give time for that investment to mature and actually start giving you returns over a period of time. So you should be patient. It's not that you invest money today and within 6 months or 12 months, that money would be doubled, right? You need to be patient, and over a period of time that you need to give them time so that that money can grow gradually. And the second, as we mentioned, is planning. So you should always have a plan in mind why you are investing the money. What is your objective? That is what actually guides your strategy. Which are the right set of investments that you should choose. So planning is very important when you make investments.
So if you talk about planning over here, I'll follow up on the same question which I asked you. If a person has an income of say somewhere between 60 to 1 lakh rupee a month, so how should he look to invest? Because he or she might have different sets of spendings over the course of the month. So what is the one thing, what's the amount or what is the percentage he should look to invest?
So I think whenever you look about investing, say like you mentioned, we take an example of a person who is earning 1 lakh rupees. The first thing that he needs to identify is what are his minimum expenses that he needs to spend in a month to, maybe support his family or whatever is the basic necessity that he is looking at, maybe house rent or the basic food expenses, travel expenses while he's traveling for work. So I think first objective would be to identify such expenses which are the bare minimum. Whatever happens, you need to meet those expenses.
Correct.
First, you allocate your fund. Suppose we come out with a number of 25,000 or 30,000 that he needs to incur on such objectives. So we need to park that money aside. After that, you need to identify your goals and what are your objectives that you need to achieve. If I say a person is earning 1 lakh rupees, 30,000 is the minimum expenses that he needs to incur. That doesn't mean he has a surplus of 70,000 available to invest. There may be a lot of other expenses which he may want to incur, to live a very comfortable life. So, that's where the planning and the strategy comes into picture. I think a person should look while investing, there should be three sets of pools that he needs to create. One is for contingencies. When you look at contingencies, one is something that can, entirely erase out your investments or the savings that you have created over a long period of time. For example, recently we had the pandemic that people actually, ended up losing a lot of their savings on health expenditure.
Right.
So such are the contingencies that you actually need to plan for. So I think when you look at investments, you also need to keep a particular corpus available towards contingencies. And a very important role that you need to, very important instrument over here could be insurance. Again, insurance can be of two types. One is of your health insurance, which is actually going to look after your health in case there is a health contingency. Second will be your life insurance, because suppose something untoward happens to you, you need to plan for your family, right?
Correct.
And that is where life insurance comes into picture. So I think these are the two things which any person should always have for themselves, one is the health insurance and one is the life insurance. Once these contingencies have been figured upon, I think the next objective would be to create an emergency fund. Suppose tomorrow you're a person who is doing a job, or maybe you're a businessman. Suppose your business is not doing good, or maybe you are laid off from your job. Then you need to plan for this emergency period wherein you may not be receiving any income on a monthly basis, but you still need to incur your basic expenditure. So you should keep allocating some funds towards such emergency. And suppose, like we mentioned, of a person who is earning 1 lakh rupees, he can have an emergency fund of say 2-3 lakh rupees. So, or maybe if he wants an emergency fund of 12 months. So he should have this emergency fund of at least 12 lakhs so that at least he can survive for a period of next 12 months, even without having any stable source of income. So that is where the emergency fund comes into picture. And after all these things have been sorted out, you should look towards investing your money into different types of investment, maybe equity, debt, and you can also choose gold.
That's a lot to ask. Let's talk about taxes now. What is the biggest myth or misunderstanding people have when it comes to filing tax?
I think one of the biggest myth that people have is that when you're filing your taxes, you're going to get something in return. Maybe you will receive a refund. Okay. So that is not always correct. I have seen people come to me, or maybe my friends come to me and say that, over the last 10 months or 12 months while I was employed, the employer has deducted X amount of my salary as tax. Now I want to file my return and I want to claim this as a refund. So I think that's not always correct. When you are filing your taxes, you need to aggregate your income from all sources, maybe salary, and apart from salary, maybe if you are having investments, you are having rental income, whatever it may be, you need to club all this income, and on that aggregate income, your tax liability is computed. So when you file your taxes, you may end up receiving a refund in some cases, in case the tax deducted or tax already paid is higher as compared to your actual tax liability. But in case the taxes collected or deposited is less, then you may also end up paying some additional taxes when you file your return. So I think that's the biggest myth that people have, that when you're filing your return, you may receive a refund, but that's not the case.
See, we all love saving tax, but is there a point where trying to save too much also becomes a mistake?
Yeah, I think, there are some set of tax filers who always want to receive something when they file their return. They want to claim taxes already paid as refund. And, and that is where they are somewhere prompted to make incorrect claims in the tax return.
Okay.
I have seen a couple of tax filers, putting up bogus claims in their tax returns against the advice of their professional, but because they want to claim a refund. And the consequences, you end up receiving notices from the income tax department. You're looking at higher tax liability because of interest and penalty, which you may have to face. So that is the cost that people don't realize while taking such steps. And with the technology really developing, the government has actually put into place a lot of system to detect and identify such bogus claims. So, when such bogus claims have come up, one of the recent trend is the department has actually started scrutinizing the house rent allowances. Traditionally people used to claim house rent allowances, but these days government really wants to verify whether these HRA claims were correct or not correct. Because, when you report the PAN to your employer, they need to report that PAN to the income tax department of your landlord. And if your landlord is not showing that income as a rental income, and that's where the suspicion arises and the department would like to investigate.
What if he's not filing the return?
So see, again, like if the landlord is not filing his return, the question is, why is he not filing his return? So there can be a scenario where his income may be below the tax filing limit. In that cases, maybe the department may just send up a simple letter and they may get convinced. But for the other part, suppose he has income which is more than the taxable limit, then the question arises why that income has not been disclosed. And if, as far as you are a genuine person who has paid rent, you have the documentation in place, I think that's not something which a person who is claiming HRA should be worried about. But I think in case you are disclosing that you are paying rental income, wherein you are paying rental expenditure, but you have not actually done so, that is something where you should be worried about. So I think the crux is, don't make incorrect claims so you don't have to be bothered.
I have a question over here. I don't know if I should be saying this in front of the camera or no, but see, I've seen people like transferring a particular amount in their parents' or their guardians' bank accounts and then putting it across as rent paid and then going for like tax claim, tax return and all. So is there a catch over here?
See, again, I think we need to understand this commercially. I have seen a scenario wherein the parents had houses in two different cities. The family or the parents were staying in Delhi and the son was staying in Mumbai. And both the flats were owned by the parents.
Correct.
Now, when the son started growing up, he wanted to live on his own, right?
Mm-hmm.
And because he wanted to be independent, he arranged for a rent agreement between himself and his parent on a purely arm's length basis, and that is how he started paying that rent to his parent, and he also claimed HRA for that particular expenditure which he incurred. So when we look at such arrangements, I think the objective here was he wanted to be independent. He wanted to be on his own terms, and because his family had an extra house in a different city where he was employed with, he was claiming that expenditure which he is incurring as a house rent allowance. So there's nothing wrong with it. So I think everything we need to see on a case-to-case basis, whether it is genuine, not genuine, and that is how things are being looked upon.
The person living in the same house.
See, again, that's a tricky question. When you see about a person who is living in the same house, the question arises, why is this rent being paid, And again, if you need to demonstrate whether there is an actual landlord and tenant relationship, who is looking after the other expenses, because if you are a tenant, you would be required to incur the maintenance bill. You may be required to pay the electricity bill. So what are those, who is fulfilling those responsibilities? That's also a question that needs to be looked upon. So as far as things are genuinely set up and things are having some commercial rationale, I think that's not an issue. But if not so, I think that can be a problem.
I think we should cut short this question away. Okay, so see, how should someone choose between an old regime versus a new regime? And what are the questions they should ask themselves before choosing one?
See, I think the focus of the government has been to make things simpler, to keep it administratively simple, both for the tax authorities as well as for the taxpayers. And that is where the new regime was invented. When you compare the two regimes, I think old regime gives you the avenue to claim certain deductions which are not available in the new tax regime. For example, the traditional ATC investments, which included the deduction for LIC premium, house loan repayment, ELSS investments, So these were the avenues which were available in the old tax regime. When you compare it with the new tax regime, these investments are not deductible over in the new tax regime. And what's the catch over here? The old tax regime is giving you these deductions, but the tax rate is, or the tax slab is aggressively placed. When you look at the new tax regime, the tax rates are beneficial. The slabs have been broken down into simpler buckets, and the effective tax rate that comes up, it's lower in the new tax regime. If I need to make a comparison, between the old tax regime and new tax regime, suppose a person has such kind of a deductible expenditures crossing a particular threshold, only in such scenarios will the new tax regime be beneficial to him. In all other cases, the new tax regime is going to be beneficial. If you look at the recent amendment, a person who has an income of say 12,75,000 rupees, he will always be beneficial under the new tax regime as compared to the old tax regime, because up to 12,75,000 you won't have to pay a single rupee of tax, as compared to if you switch to the old regime, you'll have to claim deductions, and your deductions, even after claiming those deductions, you may end up paying taxes.
Right.
So I think you need to compare what are the investments that you have made which are eligible for a tax break, and whether after taking those deductions, whether the old regime is beneficial to you or the new tax regime.
Is it that the new tax regime will have an impact on the economy?
See, I think government has planned that really well. When you look at the sources for the government in terms of taxes, one is obviously a direct tax, which you pay while filing your income tax returns. And the other is also other types of taxes, like, for example, GST. So a person who is paying lesser income tax, he has more amount of money for its disposal,
Correct.
where he can spend this money. And when you go and spend that money, you buy some product or you avail some services, there is a GST that comes into picture. Most of the services have a GST of say 12 to 18%.
Yes.
So that is also something which the government is earning. So I think the government has really planned that really well, so that, by introducing the new tax regime, although the collection in the direct taxes may be lesser, but somewhere it may also be compensated by an increase in the collection in indirect taxes. So I think on an overall basis, there should not be a very big impact for the economy.
So how should one have an investment plan, not only to save taxes, but also build wealth over a period of say 5 to 10 years?
See, when we like we spoke about earlier, the investments have to be broken down into various components, right?
Okay.
Suppose when you are choosing for certain risk-free investment, your investment bucket or your entire basket of investment should have a particular portion that has to be invested into risk-free assets. That is where the government securities come into picture. And obviously, some of these government instruments offer tax-free returns. When you look at PPF, it's a very popular scheme which gives you a return of say 7.5% or so. And if you stay invested over a long period, it has a lock-in period of 10 to 15 years. So if you are staying invested in that particular instrument for a long period, the returns which you are going to earn, that is also going to be tax-free. So, it's always very efficient to identify such instruments and invest them to save taxes as well as grow your money.
One final question before we end our show. What's one investment and tax tip that every listener should take very seriously starting today?
I think when we speak about taxes, the key is to be regular.
Okay.
Someone should always file their returns regularly, because I've seen people who file tax returns only in cases where they have a refund receivable. Okay. That's not the correct thing to do, because it's going to help you in the long run. Apart from fulfilling your responsibility as a citizen of the country, you are also having a proof of your taxes, you are discharging your taxes accurately. That is going to help you when you obtain housing loans in the future. Maybe if you want to travel abroad, that is one of the key documents which is required while processing your visa. So I think being regular and filing your taxes consistently is one of the tips that I would like to give to the listeners. And speaking about investments, I think people should start early. They should have a clear investment plan and also diversify their portfolio. allocating a lot of money towards conservative instruments, or on the other hand, allocating a lot of money towards aggressive strategies may not be a wise decision. So you should make a proper allocation and have a mix of risk-free investments as well as risk-having investments, which can actually set off with each other and give you a decent return.
So we have a balance at the end of this.
Yes, correct.
That's it. Thank you so much, Aniket, for coming over here. It was a very insightful conversation. I've learned a lot in the short conversation we had. We'll have a second part if possible in the very near future.
Definitely. Thanks, Chaitanya, for having me here.